Good afternoon, everyone, or good morning to anyone who might be joining us over in the US. It's an absolute pleasure to have you here today. My name is Joel Ellis, the Head of Investor Relations at Siloam. I'm joined here by Varun Khanna as well, our Senior Director of Investments and Commercial Operations at Siloam. We have a pleasure to actually have a live audience here, which actually consists of various sell-side analysts here in Jakarta, and likewise we do also have a large audience online as well. So it is a pleasure to have you here. The moderator for today is going to be Ingrid from Mandiri Securities. So Ingrid, I'll actually pass it over to you. Thank you so much for joining us. We really appreciate it.
Thank you, Gerald. Good afternoon, ladies and gentlemen. Welcome to Siloam's second quarter 22 earnings webinar. My name is Ingrid Gondoprastowo, healthcare analyst from Mandiri Sekuritas, and I will be the moderator in this webinar. Before we start, let's introduce the panelists. Willie, please introduce yourself and the management you bring along.
Testing. Hi everyone. My name is Willie Chandra, the Investor Relations Specialist in Siloam Hospitals. Welcome everyone to this event. So I bring along with me Pak Varun Khanna, the Senior Director of Healthcare Business and Investment and Strategy, Pak Daniel Phua, our CFO, joining through Zoom, and Joel Ellis, the Head of Investor Relations. And we are live now on Mokhtar Yadi Comprehensive Cancer Center in Jakarta, one of the Siloam flagship hospital that is specialist in cancer treatment. And also we are here with the esteemed analysts, healthcare analysts of Indonesia. We have we have Pak Jono from Hana Putirai, Pak Randy from BCA, Ryan from CIMB, Robert from Citadana, Vanessa from RHB, and Celine from CLSA, Ari from Macquarie, Amy and Ingrid from Mandiri Sekuritas. Welcome all. Ingrid, back to you.
Okay, thank you. Thank you for the introduction, Willie, and welcome to all participants joining here and through online. Today's call will have two sections. First, Siloam will be providing a brief on our results, followed by a Q&A between myself and management. After this initial Q&A, I will open questions up to the floor, here in person as well as online. For those of you who are joining us online, I'd like to remind you, if you have any questions, please feel free to ask during the call in the chat box provided in your screen. When we get to the analyst Q&A portion of today's meeting, I'll ask your question to management. For those of you who will be asking questions, please state your name and the company you work for with your question. Please note that whenever me or management refer to quarter-on-quarter or year-on-year growth, we are referring on the second quarter of 22 unless otherwise stated. Without further ado, let us start the session today. First of all, I'll ask Daniel, who is joining us online, to provide a quick brief of the financial and operational results for the second quarter 2022. Please, Daniel.
Thank you, Ingrid. Thank you for hosting us. My apology I couldn't be there in person with all of you, but hope to be able to catch up with all of you some other time. I'm very happy to be able to report Siloam's results for the first half of 2022. As you can see, we have maintained a consistent performances. And if you look at the growth from 19 onwards up to 22, you do see that revenue has been maintaining a growth path together along with EBITDA. You will notice that obviously in the 2021, the EBITDA gain was really quite exceptional. This is an over 150% increase compared to the year before. And as mentioned a few times, this is largely due to COVID. Now that has softened down a little bit for the one half of 22, but as you can see, this is still more than doubled. Basically what we were doing in both one half 20 and one half 19 from an EBITDA perspective. So definitely based on that, we can see that the company is maintaining a significant growth trajectory. Yeah. But one half 21 was a bit of exceptional years, and there were questions asked as to whether this could be sustained going forward. I think one half 22's result answers that with a very solid yes. In terms of the performances moving forward. As you can see, net profit similarly has been able to see a significant increase compared to what we were doing in one half 19, recognizing 213B of net profit by the end of one half 22. I think more importantly, though, I think it's important to highlight that as in any businesses, we say, cash is king. As you can see here, despite the fact that EBITDA dropped slightly from 21 to 22, operating cash flow improved by more than 25%. from 1H 21 to 1H 2022. And this is on account of various improvement we have brought about in the management of the working capital as well. And if you look at the growth for 1H 19, this is basically, you know, a growth of strength on strength, with a close to 43.3% CAGR from 1H 19 after 1H 2022 in regard to the company's ability to generate stable operating cash flow. And the company is able to do this with very little COVID revenue. As you can see in here, in the second quarter of 2022, the COVID revenue that contributed was about 3% as a whole. And look, 1Q 2022, we see that we previously presented to the investors that 1Q 22's COVID revenue was very low. And by very low, we meant 12%. And if 12% is very low, 2Q22 is almost nothing. We basically derive close to no revenue from COVID. Yes, as you can see, the company is still able to maintain its performances quarter on quarter. So this is the second quarter's performances, as you can see it here, whereby you will note that the revenue has continued to grow on a CAGR of 6.2%. Yeah, there was a little bit of a dip in April. We do believe that that is due to several factors. Due to the fact that it was announced for the first time that the Lebaran will not be a lockdown, that people can travel for Lebaran, and there was also a April Easter holiday. That we saw a lot of cancellation of elective surgeries because people do want to plan for their first holiday they've been able to take in the last 2 years. So April was quite a bit softer compared to previous months. But you would note that a May month, which typically a Lebaran month, this is close to 10 to 15% lower traditionally, is able to maintain its performances compared to May. And June, you do see that an increase and comeback and this contributes to a CAGR of 6.2% from April up to June. When you look at the growth in the EBITDA, I guess the growth is even more pronounced as a result of that. And what is pleasing to see that the gain in EBITDA is actually a lot more significant compared to the gain in revenue. And this is due to the fact that we were able to improve the EBITDA margin. This EBITDA margin is based on comparison to a specialist and non-specialist revenue. If we compare it to basically the non-specialist revenue only, which is, I guess, more like for like with regard to what we have been doing, then basically the June EBITDA margin that we're looking at is about 27%. Yeah, so if we were to look at the EBITDA margin on a like-for-like basis, based on what we've been previously presenting compared to the non-specialist revenue, June EBITDA margin is about 27%. Now, keep in mind, I previously have mentioned to you that we are trying to stabilize at about 25% EBITDA margin. At 27%, basically, we are surpassing what we were doing. And I believe that the trajectory will continue to be maintained. The operational results are similarly very strong. As you can see in here, that the 1Q to 2Q inpatient admissions has improved by 9%. Outpatient visits has improved by 3%. And operational result in terms of inpatient days has also similarly improved by 5%. And the growth trajectory, as you can see, is consistent from 4Q onwards. And again, coming back, as I alluded to before, this is being reliant on very, very little COVID revenue. Working capital days, I've alluded to earlier. I mean, we've managed to cut working capital days by almost half by reducing receivable days, our inventory days, and also increasing our payable days. As the company recover from COVID and venture back into normal businesses, management is spending a lot of focus on the operational excellence. And obviously, this includes ensuring that we minimize the inventory level, we collect faster, and thereby improving the working capital days. And as you can see, this contributed to the improvement in operating cash flow. Despite the slight dip in EBITDA, cash flow actually improved by 25% compared to 1H 21. Some business update I would like to share with you. First is with regard to Siloam Astri, and most of you already know Astri is one of our specialized hospitals that are focusing on the urology. And in July, Astri becomes the first private hospitals to receive the certificate recommendations for kidney transplant procedures in Indonesia. So it is the only certified private hospitals to be able to do kidney transplant. And then this is in line with Siloam's strategy to improve the complexity and acuity of cases that we treat going forward. I also want to share with you the Siloam Agora. I did mention that briefly in the last earnings call as well. This was opened in April 2022. It is the first managed services model hospital that we have opened. The hospital so far is doing well. Again, just to remind everyone, the managed services model means that it's similar to a managed hotel model, whereby investors will put in a capital for the hospitals, but Siloam would manage the hospitals as if it's one of our own. It will make use of our hospital information system, our ERP, our procurement processes, along with obviously all our SOP. It allows us to improve the network of our hospitals. I mean, the Agora is situated in the strategic locations whereby Siloam does not currently have a strong presence. Is really a win-win situations, both Siloam and our investors, in that the investors can benefit from the network effect of Siloam, and at the same time, Siloam is able to benefit from the referrals and the revenues that having a hospital in a strategic area whereby we do not currently have a presence that is able to bring to us. I also want to update on the fact that Siloam is focusing on its digital channels. We do believe that digital businesses will be very important and critical for Siloam going forward. You will note that the digitally acquired patients grew by over 100% and 158% to be precise in the first half of 22 versus first half of 2021. And currently digital channels contribute about 14% of outpatient visits. We do expect that to grow over time. We will continue to improve the My Siloam app. At the same time, dedicated call centers, WhatsApp numbers, being able to make appointments digitally, being able to track your digital queues. These are all the initiatives that we have rolled out and will continue to improve upon as we embark on our digital journey. Siloam at Home, similarly, is a services that we launched in the Q3 of last year. As a result of increasing demand for such services from COVID, we do believe that this is another key sources of revenue for us. In first half of 2022, we have served 16,700 patients, and more than 180 of our specialists are available for home care services. It is a services that we have continued to receive a good compliment from patients that have used it. It allows them an extra channel in addition to the teleconsultations to be able to have face-to-face, care with some of our doctors and nurses without necessarily have to step out of the comfort of their homes. So these are some of the highlights I would like to share with you. I think it has been an exciting quarter for Siloam as we come out of the shadows of COVID. We do see that the revenue, the non-COVID revenue, has recovered very strongly, and you see that from the operational results of the past few months. I know we're now in August, and the result has not been announced yet, but I am happy to say that the trajectory that you're seeing in Q2 will be maintained into Q3. And based on that, we do have a very positive outlook for the performances for Siloam Hospital for the rest of the year. Thank you, Ingrid. I'll pass the time back to you for Q&A. Ingrid?
Could you share the guidance for future margins? Can you hear me?
Yes, I can hear you now.
Yeah.
Sorry, I couldn't hear you before.
The guidance for future margins, what is the guidance?
So far, I will maintain the guidance that I've given previously, which is the fact that we are aiming to maintain a margin of at least 25%. As you can see, in June, reported earlier that we've really exceeded that, and we expect to be able to continue to make improvement on our margins as a whole. If you were to look at the margin for 1Q versus 2Q, I mean, 1Q, I was still sitting on about 23.4% of EBITDA margin. Second Q, that's improved to 24.4%. And this is despite a month whereby April was especially weak, and May was a Lebaran month, and therefore June has to do a lot of heavy lifting. And we're seeing that the June result is maintained and carried forward into Q3 as well, as mentioned earlier. So at this point in time, I will maintain my guidance of 25% EBITDA margins, although we are cautiously optimistic that we can do better. Sorry, any other question? I'm sorry, I'm not hearing voice.
Yeah, it's regarding the building and land acquisition for the Surabaya Hospital. Can you share the rationale behind that transaction?
Yeah, sure. Surabaya Hospitals is one of our flagship hospitals. It has served more than 655,000 patients in the past. It is recognized as being in the prime locations, and we do believe that it is a very strategic hospital for us. And we are currently planning to build a new hospitals on the site to be able to modernize our facilities, because the hospitals is getting old, and the existing hospitals would then be converted for various other purposes. The purchase of the Siloam Surabaya Hospitals help us do a few things. First of all, it obviously takes away the impact of rental. And second of all, it then allows us to own a strategic piece of our hospitals and actually help improve performances. Now, how does it help improve performances? We actually did an internal calculations. The purchase of Siloam Surabaya would actually help the impact for the group as a whole. The reason for that is that there is no longer the PSAK 73 rental lease calculations, for which that does have a drag upon the performances of the group as a whole. And also because as part of the purchase of the Surabaya hospitals, there's also purchase of the land, which does not get depreciated. So over time, the building will get fully depreciated. The land will not need to be depreciated. Whereas if we stick with the lease arrangements, lease could go up over time, and therefore by its nature, depreciation will go up over time. When we look at, for example, our net profit margins, I mean, one of the drag on our net profit margins compared to our peers is definitely the depreciation that's been charged on some of our hospitals. So we do believe that buying back some of these hospitals is in line with the strategic intent for us to own more of our existing hospitals. We are in discussions with First Read to strategically acquire more of our hospitals back over time. And I do believe that long term, this is a strong affirmations that we believe in those locations, but at the same time, it would also help improve our NPAT as a whole moving forward.
Pak Daniel, I think these are fantastic results, especially considering the changing operating environment. And my next question is regarding your receivable days. So Siloam receivable days have been on a steady downward trend. What have you and the team been doing to manage this so effectively?
Well, we've been doing quite a lot of things on the side. We've obviously been able to collect better from KMK in the second quarter, so that has definitely helped our receivable days. But at the same time, the team has also set up a monthly meeting with all our hospitals, with a key payer group, in order to make sure that we can realize the receivables earlier, and also improve on our billing time in order to continue to make improvement on there. These are all really a lot of operational excellence that we are now turning our attention on now that COVID is largely behind us. Last 2 years, obviously, a lot of attention's been focused on managing the challenges and recent issues coming out of COVID. Now that COVID is managed, yeah, we can then focus on a lot of these operational matters, which also include, as you can see, the inventory days that we've managed to bring down as well. And it is something that we will continue to focus. I don't believe we are where we could be, and therefore there are definitely further avenue to bring that down further over time.
Okay, thank you. And my next question is regarding your cost and profitability, basically. So we've seen that profitability has been very good in the recent quarter. So I just want to know what are your expectations for the costs in the coming quarters?
Well, profitability, I mean, effectively coming back, I mean, it is the margin discussions, right, Ingrid? You're trying to ask me in a different way to see if I have a different answers. I mean, the EBITDA margins guidance remain unchanged. If you were referring to the net profit margins, we have made substantial improvement in the tax rate over the past, and I don't think there will be another big jump in the future. One of the drag on the net profit margin certainly is depreciations, and a large part of that is because most of our properties are leased, and PSAK 73 with regard to how leasing is calculated in terms of its depreciation component does have a drag on our net profit margin. We do expect this to gradually improve over time as we buy back more of our hospitals. But beyond that, I think we have also been doing a lot of improvement on, let's say, for example, the material costs. The material cost initiative has started since 2019, but obviously has been impacted by COVID. And I think I shared with all of you previously, we cut down our SKU by almost 50% in order to be able to focus our purchasing power. And we do see some shift in case mix as well as we go back to normalcy. As we recover back to the post-COVID era, we see that the case mix is less dominated by certain craft groups such as oncology. In the past, there tends to be a stronger lean towards oncology because obviously when people are afraid to leave their home to go to hospitals, only the most acute cases would attract patients into hospitals. So oncology has an outsized mix in terms of a case mix. Now, oncology also have a lower material cost margins on that perspective. So as we move back to a more normal environment, I think that helps improve our material cost percentage as well. OPEX, we really just had another meetings 2 weeks ago looking at our OPEX. It's an ongoing effort. We've now appointed one person full-time, one of our doctors full-time, to look at how to improve OPEX across the group as well. So those are definitely items that we continue to work on. We do recognize, as we have presented multiple times previously, that Siloam has a superior average revenue per occupied beds and a superior revenue generation capability. What we need to really focus on moving forward in order to improve the values of shareholders is to really improve the margins from this revenue. And this is something that the management will continue to focus on.
Thank you for that, Pak Daniel. And I think it's fair to say we are on a strong financial footing for the remainder of the year. So I think my next question will be directed to Pak Farun. So as we know, Siloam has many medical specialties and center of excellences spread across the hospital units. We continue to develop new medical capabilities. Can you tell us about what new centers have you opened in 2022?
Sure, and good afternoon, everyone. It's actually fantastic to see you all here. It's been a while that we've been reporting our quarterly results, and we've seen you all join us on Zoom. So nice to see you all here. Thank you for coming. So Ingrid, yes, we continue to extend and expand our programs. Clinical strategy is a pillar that's driving our revenues. So first of all, let me tell you a little bit about two of the programs that I think will be game changers. Yeah. First, fertility is something that I've spoken about in the past. Right? I've said that this is a space where we've not been there in the past. We embarked on the fertility journey about last year, early last year, because that's the time we were thinking, what do we do during COVID? What are the kind of programs that people would like to come to? And we actually thought fertility would be a space when people are sitting at home. That's something which should do good, yeah. As we look back, it has done extremely well, extremely well. We opened a center in Palembang, and I can tell you from zero revenue to 4 billion in a month is what the program started generating. So, you know, in a way that you're looking at 50 billion revenue generated every year on account of one hospital, only on account of one program. So we've extended that program now. We've taken it to Lippo Village as well. This is our entry into Jakarta fertility. And the early signs of the revenue being generated are fantastic again. So fertility will continue to be a focus area. As opposed to something that Daniel and I and Dr. Grace were thinking about 3-4 years back, we were thinking whether partnership is the right approach or developing the programs is the right approach. I think developing the programs is going to be the way we're going to go forward on fertility. The next big thing that's happened to us is enhancing and expanding cardiology in Jakarta. You all know Kebonjeruk does extremely well on cardiology. It's a center that we're proud of. It can do anything that can be delivered on cardiology. And we realized that post the pandemic, more and more people want to stay in Indonesia for cardiology services. So we've extended that significantly in MRCCC, in Lippo Village, and we've added a complete cardiology suite in Simatupang. And that's one program where we've added arrhythmia. Again, a very sizable investment and a very sizable return is what we expect of that program. Apart from that, we've also opened the Parkinson's and Movement Disorder Center. We've started the memory aging clinic at Lippo Village, and that's one of its kind. The clinic, it's going to provide treatments for Alzheimer's disease, which in Indonesia is a very, I would say it's a huge need. The other thing that is an existing program, I think Daniel touched upon it, but I would like to re-emphasize, is our kidney transplant program. Not only have we got the license now to operate, but I think what's worth mentioning is we've already done 150 kidney transplants at ASRI. What is worth mentioning, and sometimes in the results we do talk about the quantum of work, but I think I need to allude to the quality of work as well. The global benchmark on outcomes for kidney transplant is 95% survival rate after 1 year. And this is considered as benchmark. Yeah? If you get there, people feel you're happy. A lot of you have heard Indonesian outcomes could be suspect and so on and so forth. But I feel so proud when I state that Siloam's kidney transplant outcomes are 97% survival post a year, which beats the benchmark by 200 basis points. And for those of you who understand healthcare, it is not easy. Beating by 0.1 is also not easy. This is 200 basis points. So that's the excitement in our life. Adding more to our existing hospitals, as Joel's alluded in the past. We'd like to do more in the brick and mortar that we already have, and I think we are well on that journey.
Thank you, Pak. So in my mind, there are two core components for healthcare delivery. The first is medical capabilities, contributing to great medical outcomes for patients. But secondly, there is the patient experience or satisfaction when they go to a hospital, which can be unrelated to medical outcomes. There's naturally no point in investing heavily in medical capabilities if a hospital cannot win a patient's business through providing them with a great experience when they're at our hospitals. So how have you invested in improving the customer experience, Pak?
All right, so first of all, sometimes the answer to the problem is knowing the problem itself. And our knowing the problem used to be a physical page of paper, a page which the customers would fill up when they were leaving the hospital. And by the time we compiled that paper and got inputs out of it, used to be 2 months, right? And there's very little that you can do once the patient's gone home. So it was quite evident that we need a system which actually helps us do a service recovery if at all we go wrong. So we embarked on a journey called SOFAS, which is the Siloam Online Feedback System. Now, as soon as you get into the hospital, you have QR codes which you can access anywhere in the hospital and report a problem if you have any. Not only report a problem, actually say good things also if you want to. And the way the system works, it's integrated with our operating tools. So For instance, Ingrid, if you have a complaint, let's say to do with food quality or food not being hot, and you put it in our system, which is accessible through your mobile phone, the first trigger has to be less than 2 hours for we to come back to you. If in less than 2 hours nobody is coming back to you, it is escalated to the boss of the department. If he doesn't come back to you in 2 hours, it's escalated to the next boss. Within 24 hours, the head office would get to know about that complaint if it is not resolved. Right? Now, every day we get thousands of feedbacks, thousands, yeah? And what is interesting is, from these thousands of feedback, what reaches the head office is just 2-3 feedbacks. So that means everything else is getting action. So this is a huge investment that we made into the system. I've always believed, Ingrid, that if you allow people to tell you the feedback, then they don't go and speak to the others, yeah? They only speak with you. And that's been quite evident if you see our Google ratings. 3 years back, our Google rating was 2.9 on a blended basis. And 2.9 is okay for a healthcare company. By the way, if you look at Mayo and Stanford, they'll also be 3s, yeah? So 2.9 was bad, but not that bad. But now the same companies, same blended hospitals have a rating. We have a rating of 4.3 on Google. That means more and more people are actually liking what we are doing. And the last part I must mention, food and wait times are the two things that generally come out as a problem. We've really enhanced our food. Today, the patient and attendant food is of a very different order. And I'm talking about the non-clinical side of it. The other thing is wait times. With the automation that you've seen in our hospitals, everything is now on QR and scan codes. Human intervention is limited, and I think people are going back and getting services much faster. So thank you for the question. We are actually very proud of what we've done. As a part of our presentation, we're also sharing the transformation piece on our feedback system.
I think that is very impressive improvement, Pak. So the next question is regarding expansion. Are you planning to open another hospital soon, Pak?
Well, yeah, I think Daniel's always maintained that we will continue to open hospitals, at least look out for the opportunities that we have. So on a organic basis, 1 to 2 hospitals a year. But I think another piece that you saw in Daniel's presentation, which I can highlight, is our franchise or managed services model. We did realize that the way we've opened hospitals, nobody else in the world has. I mean, find me another company which can open 10 hospitals a year. No one's ever done that. Now, I'm not saying that was the best thing that we did, by the way. But we did open 10 hospitals a year. Now, that is some amount of management capability. That is some amount of systems that have been put up in the company. That's some amount of processes that are known, because we were replicating what we did in one hospital in the other. So with that strength, we realized, why not try the managed services model, which is Agora. We launched one this year. And we launched the Agora Hospital very successfully in 6 weeks' time. We were able to automate the entire system. We were able to train every single resource in Agora. And we were able to build bridges around policies and procedures in Agora. So we've been able to templatize our hospital opening model in such a way that I think no other company can. This will allow us, or this model will allow us to expand without making investments. It's largely like we shared in the past, the hotel model, where we will get a share of the business, whether it's on the top or the bottom, without making significant investments into the hospital. So I think this model too will see some traction, is the way I see it.
Thank you, Pak. And I think next question is regarding digital healthcare. So what do you think of that? And since the pandemic, digital healthcare has become an important part of healthcare companies. How are you investing in this, Pak?
So again, digital is really 3 parts for us. One is the clinical services getting digitized. Second is what we call the digital patient channels, that is servicing our existing patients through digital patient channels. And third is developing a backend which can deliver to what we desire. Let me first touch upon digital patient channels. You've all seen that we've made our app extremely strong. Today, the app can do a lot more than just booking. You can actually do your teleconsult on the app. You can order your medicines. You can now get home care services on the app. And we've mentioned this earlier, 15% of our consumers are now digitally acquired. Now, this number is superb if I tell you that 2 years back, this number used to be 1%, right? And this is going to be an ever-growing number. This is our reach to an incremental business, which we never got earlier, right? The other things that I have to tell you, we had 900,000 downloads of this app in the first half of the year. That's like a consumer app in any other domain. And most of the people are using and engaging the app. Our engagement rates are extremely high. It has also allowed us to have targeted communication with each consumer, each patient, each customer. We are able to now, actually they are able to see their own medical records on the app itself, which is so powerful, which is so transparent. And if you're able to give transparency in healthcare to that extent, I think it's the way to go. On the second side, on the clinical side, we're doing a lot more. You will see us talking about, during the next year, a lot of AI interventions on clinical delivery. So that will take the clinical delivery to a different level. But I think I'm going to hold on to telling you more about that till some more time. Let us just complete our first couple of projects on AI, and I think we'll then come back to you and talk about it.
Thank you, Pak. And I think next question is regarding the Bali Hospital. We know that during COVID, this hospital suffered the most, Pak. So how have our Bali Hospital been doing now that international tourists can visit?
Yeah, so have you guys been going to Bali? Yeah. Do you think Kudeta and Fins are full? Yeah, do you get the tables there? I know it's great to be able to say that Bali's rocking, right? And so are we. Diving is back, sports are back, eating out is back, and when all of that happens, there is always a chance for accident. And when that happens, there is care that's provided by us to the level which is globally benchmarked. Yes, on the financial side, our Bali hospitals are growing extremely rapidly. They're back to being where they were. We've, in the second quarter itself, our Bali hospitals generated an EBITDA of 57 billion, which is a 200% increase over last year. So yes, and if the third quarter is any indication, we're getting stronger in Bali because we've started to see 2 new programs firing extremely well. One is on the cosmetic side, which is doing extremely well. We're seeing a lot of foreigners coming in for the medical program. And there's another data point that I'd love to share. Pre-COVID, we used to do 1% of our business from KITAs and passport holders. Only 1%, right? And this means that it could be foreign travelers or expats living in Indonesia. That revenue is now 3%, in excess of 3%. So that should give you an indication that how the belief is changing around healthcare delivery systems in Indonesia. And I've alluded to this trend earlier. You will see it. It's not a short-term trend, and I know Ari was talking about that to me last time as well. Indonesia will benefit from this trend for at least the next 2 to 3 decades. And every year you'll see incremental revenue coming from there. More and more people will develop comfort staying in Indonesia than going to Singapore, Malaysia, or Thailand. And that's a trend we are witnessing. I can tell you in the hospital that we are, people love to get back here. It's much more convenient, much more effective, much more a better value. It's much cheaper to be in your own country. And I think that trend is, again, significantly benefiting us in Bali.
Thank you, Pak. And regarding performance for third quarter and rest of the year, do you have any color on that, Pak?
I know you've asked this question to Daniel, and I know Daniel and I have. So Ingrid is playing a smart one on us, Daniel. She knows that you're the conservative fellow, and she kept the question for me as well. Yeah, so let me take some liberty. I know Daniel and I will have a fight on this later. You know, how we, and this is a little bit of an assessment that I'm giving you, which we will continue to share going forward as well. We look at our business from a lens which is called revenue per day, per productive day, right? And every month has a number of productive days. So very simply speaking, a February month will have productive days which are 24. Why 24? It's a 28-day month. There are 4 Sundays, maybe another holiday. We factor Sunday as half a day or sometimes less than that. There is a Saturday which is factored at 0.6, 0.7. So essentially we come down to what we call the productive day. And the other number is revenue per productive day. So it's so simple that you multiply the revenue per productive day into the productive days of the month and you get the monthly revenue. Very, very simple way of looking at it. Now, the first half is always less number of productive days. Yeah? Lebaran, February, April holidays. So when you look at it, the number of productive days in the first 6 months is about 7 to 8% lower than the second 6 months. So that means if nothing changes, we should be 7% higher in the second half. But what is also changing is the revenue per productive day for us, right? A few years back, we used to do 20 billion revenue per productive day. A few quarters back, we used to do 28 billion as revenue per productive day. The quarter that we've just reported, we ended up at about 30.5, 31 billion per productive day. The third quarter, we are running a run rate of 32, 33 billion per day. So that means not only the number of days are getting better, but in terms of what we are doing, from the surgical piece of work that we're doing, from the clinical piece of work that we're doing, we are getting better at that on a daily basis as well, right? So, so that should give you an indication that we are, as Daniel uses the term, cautiously optimistic. With 2 months gone into the quarter, the third quarter is looking pretty okay for us. And needless to say, that will lead to a better yield in terms of EBITDA. And our comfort on being able to achieve any of the guidance that Daniel's given is very high. So I hope that gives you a sense of third quarter.
Yeah, thank you, Pak. So I think the last question from me before I open to the floor. I think last week we learned from the news that there's a chatter that LPK are thinking of buying CVC's 26% stakes in Siloam. Could you provide some color on this and how would that impact Siloam's operational?
So let me get the question again. The question is, LPKR is looking at buying CVC. Is that the question?
Yeah.
Okay, so the answer is in the question itself. You should be asking either CVC or LPKR. Siloam has no comment on this. So really, a lot's always said and heard about. I think we have, so it's a shareholder transaction that we'll refrain to comment from.
Okay, thank you for sharing your insights and results, Pak Farun and Pak Daniel. Before we move on to Q&A floor, do you have any closing remarks?
Well, no. Once again, thank you for all your support. We enjoy what we do every day, and we are committed to delivering excellent healthcare in this country, and that's not changing. That's not changing. Please help us achieve our purpose and continue to support us the same way. Thank you.
That's very clear, Pak. Thank you all for your time. Now we are opening the floor for questions. For all participants who want to ask a question online, please type in your name, company, and your question in the chat box. For participants joining us here, please raise your hand, and we will give you the microphone. Thank you.
Yeah, thank you, Siloam management, and thank you, Daniel, and also Varun for these insightful presentations and also explanations on the current results. Maybe just 2 questions from me. I think the first one is related to the traffic. I'm just wondering what will be the subcategories that you have seen have yet to recover back to the pre-pandemic, in the sense that we are going to see more growth coming from this category and so on. And the second question would be, I think related to the LP Care and also CVC. I'm not basically trying to clarify whether that's true or not, but I'm just saying what would be the CVC role at the moment for Siloam, so we can better understand what happened after the shareholder transaction is basically completed, if it's true, and or if it's not. Maybe, yeah. Thank you.
All right, so Daniel, I'm going to leave the second question for you. All trick questions are being passed to you, so let me take the volume side of it. It's a very interesting question. We're looking at it each day. I think three interesting trends here. One, surgical business is better than ever before. And that's a happy state. Yeah. That's a happy state because it adds to our complexity. It adds to the term that Daniel used, RPOP. And it also brings sustainability and stickability to your revenue, right? Because malaria and dengue will happen when malaria dengue happens. But surgeries are needed as we grow older. And if there is comfort for surgical business in a particular hospital, you will always be comfortable getting your medical piece done there as well. Internal medicine got back to almost the levels of pre-pandemic. It was something that was slow to grow back, right? Most of the specialties, have actually gone back either at or well beyond the levels of pre-COVID. And that's quite evident. You've seen our revenue growth over pre-pandemic is 50%. So needless to say, every craft group has to grow. Only one craft group on a blended basis hasn't come back to the pre-pandemic level, and that is pediatric, where I think it's got back to about 80-85% now. During COVID, it went down to about 40% because kids were not going to school. They were in the comfort of their houses. And largely that led to a drop in the pediatric business. Now, having said that, our pediatric contribution is very, very small, as you know. Right? It's a very insignificant, not insignificant, but very small percentage of our business. So that's the only craft group that's not back to pre-pandemic. All others are either at or significantly higher. Daniel, the next question I think was reiterated, as Ingrid also asked, if there's any comment that you have on CVC and LPKR, maybe Joel.
Maybe before the CVC questions, let me add to what Varun is saying. I mean, as mentioned, I'm usually the more conservative of the two. I speak based on the actual data. But the actual data I can talk about since we're already in August. Obviously, I've got another extra 2 months to see from there. And I can see that, the performances after June is better than June. And we do see a consistent month-on-month improvement upon that. But even having said that, if I were to look at my latest throughput data, say for example IPD, even as of this month, I'm still at least about 15% and lower compared to the pre-COVID times. So throughput is definitely not back to the pre-pandemic level. Therefore, there will still be various room for growth, as Varun alluded to. For example, pediatric is seeing a steady growth, but we're still seeing a gap compared to where we were pre-pandemic. So, the opportunities to have a higher growth for coming months is definitely there. And I think this is also predisposed upon the clean hospital strategy that Siloam has taken, whereby we have ensured that all our hospitals is focusing on recovering base case. And we always believe that needs to be a key focus in order to make sure that we can run faster coming out of the pandemic compared to the others. In regard to your questions on CVC, again, I reiterate Varun's point. We obviously can't comment on anything the shareholders wish to do on their side. Except there's one thing I can say is that our relationship with CVC has improved substantially since 2-3 years ago. I would say that, say 3 years ago, CVC will be very involved. They will have various VCP they want us to run. They will have various internal meetings that they will sit on, and basically very involved in terms of how we run our operations. I would say, honestly, over the last year or two, and Varun can probably echo the same, they have been stepping out a lot. And to an extent whereby there was a time whereby Varun say, CVC, we miss you. We haven't seen you for a long time. And I still remember a key management from CVC saying, look, we leave you alone if we think that, you're doing well. We have obviously much more, we have a wide portfolio and our attention is always focused on areas that require our attention. So for the last year or two, I would say CVC's involvement have been very little. And I think that is a testament to the trust and faith that they have in the current management team to be able to execute and to be able to move forward. So we have a great relationship with CVC, but if CVC was to exit, so to speak, would anything substantially change in terms of how we run things day to day? Absolutely not.
Thank you, Daniel and Varun, for the answers. I'll go back to the queue and let other attendees to ask us questions.
Yeah, I'm Amy from Mandiri Sekuritas. Congratulations to the management for the excellent result. I have several questions from my side. The first one is, may I clarify for the medical capabilities investment that you've mentioned, is it already rolled out? And if yes, may I know when did the oncology, neurology, pulmonology, urology, and cardiology center started operating? And any plans to add other capabilities and the timelines as well? That's the first one. And the second one is regarding the revenue per patient, both outpatient and inpatient growth is higher compared to the peers. Can you tell us why? Is it due to the case mix, or is it due to the value-based pricing initiatives that you've made? I'll stop there first. Thanks.
First of all, thank you for congratulating us. We're extremely happy as well. You have asked me questions that I can speak on for the next 24 hours. So let me try and prioritize the answers. Yes, all the programs that we've spoken about, we've launched. So there is no work in progress that we've reported today. Everything that we've spoken about is everything that has been launched in the first half of the year. We have neurology, uro, and all of these programs already that you alluded to. The specific programs that I gave you have been launched in the first/second quarter. Some of the programs were launched in the second quarter, therefore the impact of revenue is not for the full quarter. So the cardiology program that I mentioned to you, it's a very large program, will start impacting fully in the third and the fourth quarter. The Lippo Village programs that I spoke about have already started impacting. They were launched in the end of first quarter, and therefore second quarter has been a full quarter for them. But again, as you know, new programs ramp up, and their growth rate is quite inorganic. So we expect these programs to grow about 100 to 150% year on year. On the fertility side, we launched the Palembang program last year, so it already has a 4-quarter cycle to it. The fertility at Lippo Village started in the first quarter, and the full impact will be seen by the end of fourth quarter this year, because fertility again takes a while to build up as a program. For us, there are two things that are going to be very key going forward. We've embarked on one cost-saving initiatives that Daniel alluded to, and I won't touch upon that. The second most important thing that we are doing is enhancing our clinical strength. And we are going from strength to strength. We are already very high, and this will answer your second part of the question as well. Our complexity is high up there in Indonesia. And that's one of the reasons our ARPOB is twice as much of our competition. Of course, pricing plays another role. Payer plays the third role. Our payer contribution, you see our BPJS contribution is well below 20, and our insurance and corporate is climbing almost every quarter. We are currently running at about almost 44% business coming from corporate and insurances, another 40% coming from out of pocket. So the clinical program piece that we're talking about, we're looking at enhancing many other things that are not done in Indonesia. But having said that, we will let you know each quarter we roll out the program. We don't want to go out and announce the programs in advance, but I can tell you we'll do more than what we've done so far, both in terms of bringing technology and associated talent in the next 4 quarters. So that's largely the question to both your, the answer to both your questions. Daniel, if you want to add something.
No, I think it's very adequately answered.
Thank you, Siloam team, for the updates today, and well done for the second quarter, quite resilient results. So my first question in regards to the hospital segments, right? How should we think about the growth recovery across various segments, for example, flagship, mature, ramping up, and so forth? Just wanted to get some sense about how we see the EBITDA margin improvement across from the segment perspective. So that's going to be my first question. Thanks.
Dan, do you want to take that on the segment-wise EBITDA?
Yeah, I think it's really two questions, Ari. I mean, the first thing on the revenue perspective, and then I'll touch on the EBITDA margin after that. Certainly, if you talk about in absolute dollar term, which of our segment will contribute the most improvement in revenue and EBITDA, obviously that will be from the flagship. And then after that, it will be the mature. Because relatively speaking, the relative contributions from the flagship is substantially higher compared to the ramping up especially. But then on a percentage basis, obviously the story then becomes a bit different. We do believe that the ramping up segments do have a substantial room to be able to add new revenue to the group as a whole. And I think what we've alluded to previously is that there's a lot of effort to focus on the turning around the loss-making hospitals. And as a result of these hospitals improving, the EBITDA margins for the group as a whole then would also improve. I think as Varun answered earlier as well, different segments, we have definitely different strategy and different way of looking at it. The flagship being at close to full capacity, I guess the focus is on looking at how do we improve the payer mix, I mean the case acuity, the complexity, which is why, for example, LV, we are currently planning to launch an enhancements of the oncology program that's being operated in there. There is a plan to, I mean, you probably understand MRCCC is not meant to be a one hospital exercise. MRCCC as a brand name is meant to be applied to multiple oncology center of excellence that we intend to grow throughout Indonesia. It's not just as Semanggi. So definitely those plans are being looked at as well across our other flagship hospitals. So in those terms, I would say that it would really come from all our segments, except the way the strategies that will be applied for each of those segments will be different. For example, the distinct segments, the Bali Hospitals, is very much just about getting back to the pre-COVID era. It's about getting the tourists in. We have the G20 coming up, and there's a lot of factors that is working in its favor. But I think, again, Varun can probably speak on this a lot more. Fundamentally, though, what is going to help our revenue is that the patient's experience has been improving significantly over the past 2 years. Since Varun came on board and the patient's experience program, you can look at the Google rating, you can look at our feedback, you can look at various benchmark that has been done, but not internally, but externally. And I think that is going to be what will drive our business growth going forward. I mean, certainly having more complex and more varied services is going to be important, but ultimately, I think the patient experience will be the key.
So let me take the opportunity of adding a little bit. We capture Net Promoter Score, and it's something that is now digital and therefore cannot be altered. So the numbers that we see are the real numbers. Initially, we used to be surprised with the numbers that we were getting for this year. We were getting a Net Promoter Score of 79%. And if you see global benchmarks, you'll find it incredibly high, right? So we went ahead with an external audit of the score, and the external auditor, independent auditor, came back with a score of 76% from a random customer base across various hospitals. We also did this benchmarking study vis-a-vis our competitors and peers, and we are happy to say that we were significantly higher than most of our competitors in Indonesia.
Thank you, Varun and Daniel, for the explanation there. My next question in regards to the kind of payer mix, can you just share more color in terms of the growth from the private insurance standpoint versus BPJS? Is there any interesting trends? I assume that basically the private insurance penetration uptick has been quite strong since COVID.
Quite strong, yes. I'm sure you have the data, but I can show you the data again there on your screen. 82% business is actually coming from non-BPJS. And for those of you who've been looking at healthcare as a market, you must be recalling 4 or 5 years back, there was this unspoken piece around healthcare that everything will be BPJS. Having gone through the cycle of the last 5 to 7 years, you can now be assured that while BPJS will support a large part of the masses, there'll always be room for people wanting more. Which is where the penetration, Ari, has actually gone up significantly on private insurance. I'm seeing all insurance companies celebrating because they're getting more and more people coming and taking policies. And the simple trend is we follow. The higher the penetration on insurance, the better it is for healthcare providers who are, the higher tier healthcare providers. And we seem to be on top of that tier currently. So biggest beneficiaries of insurance penetration. I understand the penetration numbers are about 12, 13 million now, from a low of 1.52 million 7 years back. So that continues to be very good. A few of our friends in insurance do tell us that the policy growth rate continues to be double digit for them. So that's the trend, and that trend is going to stay. The other thing that I have to tell you, in most emerging markets which have a universal healthcare program would have witnessed it or will witness it. A universal healthcare program actually gives you the access. Once you get the access, you start to aspire. And Indonesia as a country is a very aspirational middle class country. Once you get access to a healthcare, you want better and better and better care. So I think people will get insurance penetration enhanced, and I think that will be a trend that will, again, be very, very positive for healthcare delivery organizations in Indonesia.
Got it. Thank you, Varun, for the color. All the best.
Thank you.
Sorry, just follow-up questions from my side, if I may. So in terms of the inpatient days admission in second quarter 22, we are seeing it still lower than second quarter 19.
Yeah.
Can you tell me why is that? Thank you.
So that's a very good trend, very good question, actually. I think there are 3 things that you should look at when you're looking at inpatient days. You should also look at number of inpatients. Then you should look at the OP to IP conversion. And those matrices will define the full understanding of what our business quality is. In terms of number of inpatient days, if you're able to retain your inpatient admissions, it's a good thing. That really means that your average length of stay is coming down. That really means that you're doing a better clinical job. That means, so I just explained to your question, that we're getting more surgical business, yeah? Higher surgery business we're getting. And surgery is significantly higher revenue than medical cases. And if we are able to send back the surgical cases home early, that means we are doing meticulous job on surgery. That means we are reducing the average length of stay. You get that? That means without opening more hospitals, we are creating more capacity in our hospitals. So a patient who would have gone home after a surgery in 5 days, if you can send back the same patient in 4 days, that means you've done a good job of surgery and still saved the night for the patient and for yourself. So that's what is happening with us. Our average length of stay has been getting better every passing year, which is a great thing from a clinical outcome standpoint. Yeah? So when you're looking at your business side of it, look at inpatients and outpatients and the conversion ratio. Inpatient days is actually a measure of how effective we are getting clinically. So it's a good trend is the way I'd like to answer your question.
Go ahead.
Hi, Varun, Joel, and Willie. Hi, Daniel. Congratulations for the results and thank you for the presentation. I'm Vanessa from RHB. Got couple of questions from my side. Maybe the first one regarding the price increase. Have you conducted price increase in the first half of 2022? If yes, do you plan to still conducting another price increase in the second half of 2022? That's my first question. Second one regarding the BPJS reimbursement. If I'm not mistaken, the government plans to increase the INA CBG reimbursement. Any color on that? I think I'll stop there first.
So I'll take the first question, Daniel, and I'll leave the second question on the BPJS side for you. Price increase, as you know, is a standard thing in our business. There is always a consistent price increase that Siloam has started and will stay. So our cycle of price increase is 1st January to 30th of June. Apart from 2 hospitals, we've completed the cycle this year. The impact of price last year was 250 odd billion, and we don't expect the impact to be any lesser this year. There are 3 pieces. It's not just the price increase. We've actually done or embarked on a multi-year price optimization journey that I spoke about last year. The first piece of that optimization is price standardization. Because our hospitals came up in various parts of the country at various times, tariff was different in similar hospitals. So 2 flagships could have differential tariffs. So we did intend to standardize it by category, category that you all just spoke about, flagship, distinct, BPJS, ramping up, and also the class of cities, based on competition around us. So we've done that standardization as well, a part of that already done. 2 LOSs are yet to be standardized, and that will happen over the second part of this year and the next year. So apart from the price increase that we take annually, standardization will have a mildly positive impact. The third part of it is we continue to do our value pricing study. The studies just come back for this year, about a week back. We are in the process of analyzing the study. So whatever comes out of that would become a part of what we then go ahead and take in the 4th quarter, probably the 1st quarter of next year. So it's a very continuous process. What we can always tell you is how much was the previous year impact. So the previous year impact we've told you, I don't think this year would be any less. Daniel, on the BPJS piece, I'd leave it for you.
Sure, Varun. Look, on the BPJS side, I obviously can't comment on the government policy. But what I can say, though, is that I believe the condition supports, I guess, the update or revisions of the BPJS tariff. It has been over 5 years, I mean, since the last adjustments. We understand, obviously, with COVID, that a lot of resources and attention was diverted towards COVID. As COVID dies down, I think the resources can then be focused elsewhere. Also, you obviously would have heard about the discussions to standardize the BPJS premiums to get rid of the 3 classes down to 1 or 2 classes. I think as part of this review, it would then obviously make sense to look at the tariff and adjust that at the same time. Again, I can't comment on specifically what the government has in plan, but I do believe that the overall macro factors is supportive of a rate revisions sometimes in the near future.
Include in the price adjustment. Can I know which hospital that you exclude, those 2 hospitals, I mean, and how much is the price adjustment in the first half of 2022?
We don't quote a half-yearly number. We'll give you the number by the end of the year because we don't do that tabulation every month on price increase. So that's why I gave you the last financial year upside. The 2 hospitals for the balance part of the year will contribute close to about 3-4 billion, so it's not a big number. It's small hospitals that for operational reasons have not been impacted in price.
Okay, get it. Thank you. Maybe my next question is regarding the managed service model. Can you share in terms of the revenue sharing that you conduct, especially with the Agora? And going ahead, do you have any specific target in terms of the hospital expansion that will be conducted under managed services? And maybe could you also share the EBITDA margin if you compare to the organically expansion hospital?
Daniel, you want to take it?
Yeah, sure. I think with regard to the EBITDA margins, let's look at it this way. We can look at it from two angles. One is from the investor's angle and one is from our angle. From the investor's angle, the way you should look at the EBITDA margin should be no different to any of our own hospitals. That's obviously what we try to maintain and manage. It's no point delivering the investors a lower return than they would otherwise get by assuming that it's one of our own hospitals. In terms of our return and our margin on it, I guess you got to understand that this is we will be getting a fixed fee. Yeah, so there is it will be a net fee, but the resources that is deployed in there are resources that we would otherwise already have. Any additional costs that is incurred on behalf of Agora will be charged directly back to Agora. So we wouldn't be taking on any costs. Yeah. So based on that, basically from Siloam's perspective, it will be a net income coming in as a result of the managed services model. Now we obviously has a very detailed agreement with the investors with regard to how these management fees get paid. There is a flat component that is relatively small, and then there is obviously a component that is based on the percentage of the EBITDA that has been achieved that scales up but depending on the achievement. So to make sure that the two sides' interests are aligned. Now the exact specific of the fee calculations and so forth, we are under confidentialities. I mean, with the investors, so we can't disclose that. It is also the first example of such a managed services model. So going forward, we might tweak the model further. What we can say though is that we are investing time and resources, to make sure that this is a success. There is very little marginal cost to Siloam because it is using existing management structures, existing systems, as I say. Any additional cost incurred is borne directly by the investors, but it does require management attention and focus, obviously, no different to any other hospitals that we open. And we are giving it a priority. We want to make this work in order for this to be a showcase for future expansions of Siloam going forward as well.
Two last questions. The first one regarding your acquisition on the Surabaya Hospital. Could you also share the amount of capex you allocate for the acquisition? As well as you mentioned, you expect a kind of NPAT improvement after this corporate action. Could you maybe give us some color in terms of the net margin improvement? How much margin improvement in terms of the percentage point, or maybe on any kind of metrics that you can share after you take out the depreciation as well as the lease? And maybe my last questions to Mr. Varun regarding the Siloam Home Care. Could you also share about how big the contribution at this moment? And just want to clarify, does this services integrated into my Siloam apps, or is a kind of different apps that we need to install to get this service? I think that's all. Thank you.
Sure. For the Surabaya hospitals, there are various components around it. Obviously, there's acquisition of the existing Surabaya hospitals. There's also the component related to building a new hospitals next to the existing hospitals, converting the current hospitals and so forth. I would say for current year, let's say we've budgeted about 600 to 800 B of spend for Surabaya Hospital. Again, this is not just for the land purchase, as mentioned. This is also involved the building of the new hospitals next to it and transforming the existing older hospitals for other use. With regard to the NPAT margin improvement for Surabaya itself, there's about 2% improvement in NPAT margins by virtue of purchasing back the hospitals instead of continuing to pay lease upon that. It's a small but definite noticeable improvement with regard to the NPAT margins.
All right, so home care, a new business for us and doing extremely well. As far as the numbers are concerned, we don't report it currently separately, but I'll give you some cues so that you can assess in terms of how powerful the business is. So first, when we started, there was only home care was being used for very limited services. Now we've gone to a stage where we've piloted the whole operation. Our delivery systems have been perfected. And therefore, the suite of services or the spectrum of services is quite complete. We can deliver home care services for something like a COVID testing, for your labs. We can deliver home care services for pediatrics. We can deliver home care services for COVID treatment. We can deliver home care services for post-surgical recovery. So the spectrum is pretty large, and I guess by the end of this year, it would be something that we'd love to call complete. As far as the service network is concerned, we've already delivered in the first half 16,000 patients, right? And that's quite a number, if I can tell you that. 180 specialists have been dedicated to home care, so it's a large business as far as we're concerned. And yes, you can avail of this service through the mobile app. So it's very simple. You can actually call up the call center, you can call up a WhatsApp number, and you will have limited services available on this as well. What we also do, once you get surgery or you get treated at Siloam, the doctors will also assist in case you need follow-up home care for yourself.
Okay, got it. Thank you. Best of luck.
Thank you.
Thank you. I think I have one last question, very quick one. Just want to follow up on Amy's question actually. So we know that the LOS is actually lower, that's good. But I think the inpatient admission is also lowered compared to the second quarter 19. So can you have some color on that?
It's basically the second quarter 19.
Yes.
Or the first quarter?
Second quarter 22 compared to second quarter 19.
Yeah, so you'll see a significant upside in terms of second quarter because the second quarter 19.
Yeah.
Sorry, say that again. You're saying that inpatient is lower?
Yeah, inpatient admission is lower in second quarter 22 compared to second quarter 19.
Let me review that number.
Okay.
That could be a little bit of a challenge on the number side. Let me review the number again.
Okay,
Yeah?
sure.
Thanks.
Yeah, thank you. So I think we have answered all the questions, and even in the, I think in the online we have one, but we also have answered that just now. So if there's further question, please feel free to reach Siloam's team directly. And thank you, Pak Farun, Pak Daniel, Joel, Willie for the insight and discussion. And thank you everyone for joining the session. I wish you have a great day ahead. Thank you.
Thank you so much.
Thank you, Ingrid.